There is a window in your retirement that most people never find out about until it is already closed. It does not come with an announcement. It does not send you a reminder. It opens quietly when you stop working, and it closes just as quietly when you turn 73. And what you do inside that window, or what you fail to do, determines how much of your own money the government gets to keep for the rest of your life. Most retirees miss it completely. Not because they are careless, not because they are bad with money, because nobody told them it was there. They spend their 60s doing what feels responsible, leaving their savings alone, letting the accounts grow, telling themselves they are being careful, and then at 73, the forced withdrawals begin, and the tax bill that arrives is nothing like what they expected. It is double, sometimes more, and by then the window is closed and nothing can change it. That is what this video is about, the Roth conversion window. What it is, why it closes forever at 73, what it costs when you miss it, and exactly how to use it before it disappears. If you are anywhere between 60 and 72 right now, this is the most important retirement video you will watch this year. Not because I say so, because the math says so. My name is Jack, and this is Jack Retires. This channel exists to take the retirement traps the system keeps quiet and lay them out in plain English before they cost you. I am not a lawyer, I am not a CPA, I am not your financial advisor. Everything here is educational, based on current 2026 tax law and public information. Always confirm with a qualified professional before making any changes. If you are in your 60s and you want to protect what you spent a lifetime building, subscribe to Jack Retires right now and hit that like button. It costs nothing. It takes 2 seconds. And it is the only way this reaches the next person sitting inside the window right now without knowing the clock is running. Let me tell you about a couple named David and Carol. David is 71. Carol is 69. They retired 6 years ago. Between them, they built $860,000 in traditional IRA accounts over 3 decades of careful saving. They own their home. They collect Social Security. They live comfortably on about $58,000 a year, and they have barely touched the retirement accounts because they do not need to. Those accounts kept growing. And David and Carol have been proud of that. A growing account feels like success. It feels like they did everything right. Here is what nobody told them. When David turns 73 in less than 2 years, the IRS is going to force him to start pulling money out of those accounts whether he wants to or not. And because the accounts kept growing while they did nothing, the amount forced out in that first year will be somewhere around $32,000. David does not need that money. He did not ask for it. But it is coming out. It will be taxed as ordinary income. It will stack on top of their Social Security. It will push a large portion of those benefits into the taxable zone. And 2 years after that first big forced withdrawal, their Medicare premiums will jump because Medicare looks back 2 years to decide how much to charge. David and Carol did not make a mistake. They saved diligently. They left their accounts alone. And that is exactly what is going to cost them. The window they had, those years between retirement and 73, when their income was low and their tax rate was at the lowest point it would ever be in retirement, that window is almost gone. They have maybe 2 years left, and most of it passed while they were not watching. Stay with me here, because I want to show you exactly how this happens to people who did everything right, and what you can still do if you have any time left in the window at all. Here is something about your traditional IRA that most people never fully think through when they are putting money in. That account is not entirely yours. A portion of it has always belonged to the IRS, not because they are being unfair. Because you made a deal the day you opened the account. The money went in before taxes. It grew without being taxed. And the agreement was always that the IRS would collect its share later. The account that feels completely like yours has always had a silent partner sitting inside it, waiting. And at 73, that partner shows up to collect on their schedule, not yours. And here is what makes that dangerous. You do not get to decide how much the silent partner takes or when. The IRS has a formula. It forces a percentage of your account out every single year starting at 73. That percentage increases as you get older, and the amount gets calculated on your total balance. So the larger the account, the larger the forced withdrawal. David and Carol's $860,000 will force out roughly $32,000 in year 1 alone. If they had spent the last 6 years gradually moving some of that money into a Roth, the account would be smaller. The forced amount would be smaller. The tax would be smaller. Everything downstream would be smaller. They did not do that because nobody ever showed them the window existed. And now I need you to understand what that one forced withdrawal actually does. Because it does not stop at being taxed once, it triggers a chain, and the chain is where the real damage lives. When that $32,000 forced withdrawal lands in David and Carol's income, it does 2 things at the same time. It gets taxed as ordinary income at their current rate, and it raises what the IRS calls their provisional income, which is the number used to decide how much of their Social Security gets taxed. So that single forced withdrawal does not just carry its own tax. It drags another $1,000 or $15,000 of Social Security benefits into the taxable zone alongside it. They are being taxed on $42,000 or more when only $32,000 actually came out of the account. Their real effective rate on that withdrawal is far higher than their tax bracket suggests. Financial planners call this the tax torpedo, and the name fits because it hits far harder than anyone expected and comes from a direction most people were not watching. Then 2 years later, the third hit arrives. Medicare looks back 2 years to decide your premium surcharge. That large income year in 2026 shows up in their Medicare bill in 2028. They have completely forgotten what caused it by then. The bill just appears and they pay it without connecting it to a withdrawal from 2 years earlier. 3 separate costs from one event. The withdrawal tax, the Social Security tax it triggered, and the Medicare surcharge it created 2 years later. All from one forced distribution that would have been smaller, or avoidable altogether if the account had been reshaped during the window. This is what I mean when I say people pay double. Not double on one thing, double across the entire structure of their retirement. And it traces back to years they spent doing nothing, because nobody told them doing nothing had a price. Now let me show you what the window actually is. Because once you see it clearly, you cannot unsee it. The window is simple. It is the gap between the year you retire and the year you turn 73. For someone who retires at 62, that is an 11-year window. For someone who retires at 65, it is 8 years. For David and Carol, who retired at 65 and 63, that window opened 6 years ago, and it is closing in less than 2 years. Inside that window, something important happens. Your income drops to its lowest point in retirement. You are no longer earning a salary. You may not yet be collecting Social Security, or you are collecting a modest amount. You are not yet being forced to pull from your accounts, and your tax rate sits at the lowest level it will ever be for the rest of your retirement. Most retirees inside the window are paying tax at 12% on their taxable income. Some are paying even less. That low rate is the opportunity. Because you can choose to move money from your traditional IRA into a Roth account during those years. You pay tax on what you move, but you pay it now at 12%. Not later at the much higher effective rate that arrives when forced withdrawals, Social Security taxation, and Medicare surcharges all stack on top of each other in your 70s. You are choosing to pay a small controlled amount today to permanently escape a much larger forced amount tomorrow. That is the entire logic of the Roth conversion. And the window is the only time in retirement when the math strongly favors you. Once the window closes, the equation flips completely. At 73, forced withdrawals begin and your income rises whether you plan for it or not. Roth conversions on top of forced withdrawals push you into higher brackets. The tax on each dollar converted gets more expensive, and the Medicare surcharge risk grows with every additional dollar of income. The same conversion that costs 12 cents per dollar inside the window can cost 22 or 30 cents per dollar outside it. Sometimes more. The window does not just close, it locks. Let me put real numbers on David and Carol so you can feel exactly how large this difference is. If they do nothing for the next 2 years and forced withdrawals begin at 73, here is their income picture in year 1. Forced withdrawal of roughly $32,000 from the traditional account. Social Security of around $42,000 combined. At that level of provisional income, up to 85% of their Social Security becomes taxable. Their effective taxable income climbs to somewhere between $68,000 and $74,000, even though they only needed $58,000 to actually live on. Their federal tax bill jumps significantly above what they are paying today. 2 years later, Medicare surcharges arrive based on that high income year. And this pattern repeats every single year, with the forced withdrawal growing larger as they age, until the accounts are finally drawn down. Over 20 years of retirement, the extra tax they pay by doing nothing right now could easily reach $60,000 to $90,000 above what they needed to pay. Now look at what happens if they use the 2 years they have left. If David and Carol convert $30,000 this year and $30,000 next year, staying carefully inside the 12% bracket each time, they pay about $3,600 in federal tax on each conversion. That is $7,200 total. That $60,000 moves into a Roth. It grows completely tax-free. It never triggers a required withdrawal. It never adds to their provisional income. It never pushes their Social Security into a higher taxable zone. And when they need it in their 80s, it comes out with no tax at all. Going into the forced withdrawal years, the traditional account is $60,000 smaller. Required distributions at 73 are smaller. The Social Security tax hit is smaller. Medicare premiums are lower. The tax torpedo hits softer. Over 20 years, the difference between those two choices can be $60,000 to $90,000 that stays with David and Carol instead of going to the government. Not because the law changed, not because they found a loophole, because they made one decision inside a window that was still open. They paid $7,200 to protect $60,000 to $90,000. That is the Roth conversion window, and it is only available while the window is still open. Now, I want to say something honest before I give you the action steps. I hear from people every single week who found out about the Roth conversion window after it closed. They are 74 or 75. They are dealing with large, forced withdrawals they cannot control. And they want to know what they can do now. There are still tools available to them. Qualified charitable distributions, careful sequencing of withdrawals, coordinating which accounts they draw from first. Those things help. But the window, the years when they could have moved money at a low rate on their own terms before the system forced it out at a high one, that is gone. And the difference is visible every single year in their tax return. The retirees who used the window did not earn more. They did not make smarter investments. They simply knew the window was there and acted before it closed. That knowledge and that action is the entire difference between two retirements that look identical from the outside, but cost completely different amounts in taxes year after year. So here is exactly what to do right now, this week, not eventually. First, figure out how many years of window you have left. Take 73 and subtract your current age. That number is your window in years. If you are 64, you have 9 years. If you are 70, you have 3. If you are 72, you have 1. Write that number down. It is the most important retirement number you have right now because it is the one that is actively shrinking. Second, look at what you currently pay in tax and how much room you have left inside your current bracket. If you are a single filer, your 12% bracket tops out at $47,150 of taxable income. If you are married filing jointly, it tops out at $94,300. Take your current income from all sources, Social Security, pension, any withdrawals you are already taking, and subtract it from that bracket ceiling. The gap between your income and the ceiling is your conversion room this year. That is the amount you can move at 12% right now, without triggering a higher bracket, without triggering the Medicare surcharge, at the lowest rate you will see in retirement. Third, do not skip a single year inside that window. Every year you do not convert is a year that money stays in the traditional account, keeps growing, and makes the forced withdrawal at 73 larger. The compounding works against you in the traditional account and for you in the Roth. Time inside the window is not neutral. Unused years have a cost that shows up at 73 and every year after. Fourth, if you are already past 73 and the window is closed, the qualified charitable distribution is your most powerful tool now. If you are 70 and a half or older and you give money to charity, a QCD lets you send money directly from your IRA to a qualified charity. That amount satisfies your required minimum distribution, but it never appears in your income. It does not trigger Social Security taxation. It does not push you toward the Medicare surcharge. If you give to charity anyway, this is simply the smarter way to do it. The window is the entire game. Everything else in retirement tax planning, Roth conversions, Social Security timing, Medicare management, it all connects back to whether you used those low-income years while they were available. Not one of those tools works as well after 73 as it does before. Not one of them gives you the same leverage. The window is where ordinary retirees who saved carefully can protect what they built. And it is open right now for anyone under 73. Before you close this video, 2 things I want from you in the comments. First, subtract your age from 73 and drop that number below. If you are already past 73, type 0. I read every single comment, and seeing those numbers tells me exactly who I am making these videos for and what to focus on next. It also tells me how many people are still inside the window and how much time they have left. Second, before today, did you know the Roth conversion window existed? Did you know that the years between retirement and 73 are the lowest tax years of your entire retirement, and that what happens in those years shapes your tax bill for the rest of your life? Just type yes or no. I already know what most of the answers are going to be, and that answer is exactly why Jack Retires exists. If this video showed you something the system was never going to tell you on its own, hit the like button right now before you leave. Every tap tells YouTube to find the next David and Carol before their window closes instead of after. One tap from you could reach someone who still has 8 years left and does not know it. Subscribe to Jack Retires if you have not already. Every week one retirement trap explained in plain English before it costs you. That is the only reason this channel exists. And share this with one person in their 60s. Just one. Someone who is sitting inside the window right now without knowing the clock is running. That one share could be worth tens of thousands of dollars to them over the course of their retirement. That is not a figure of speech. That is the math we just walked through together. The window does not wait, it does not extend, and it does not come back. I will see you in the next one.